Please subscribe, like, and share. It really helps us out. And of course, if you have any questions, comment below, and we will answer you as soon as we can. Welcome to this video in our series on A-level economics. Today we are looking at 3.1, business growth. If you haven't seen our previous videos, click on the card above.
Firstly, for today, reasons why some firms tend to remain small and why others grow. Firms grow for a number of reasons: to make more money, to gain monopoly power, and for greater security. By growing, a firm will be able to experience economies of scale, which helps them to decrease their costs of production. They will also be able to sell more goods and therefore make more revenue. Together, these will help a firm to make a larger profit, and many firms are motivated by profit. A larger firm will hold a greater share of their market. This will give them the ability to influence prices and restrict the ability of other firms to enter the market, helping them to make profits in the long run. Monopoly power often means firms have monopsony power, and so will be able to reduce their costs by driving down the prices of their raw materials. A larger firm will have more security, as they will be able to build up assets and cash which can be used in financial difficulties. Moreover, they are likely to sell a bigger range of goods in more than one local or national market, and so they will be less affected by changes to individual products or places. However, not all firms grow. Some remain small because of constraints on growth, the size of the market, access to finance, owner objectives, and regulation. Not all firms want to grow.
Secondly, let's look at the principal-agent problem. In many large firms, there is separation of ownership and control. Firms are owned by their shareholders, who play no part in the day-to-day running of the business. The chief executive and senior managers work for the company and control day-to-day decision-making. Shareholders are represented by a board of directors, who oversee the way the business is run. They are able to vote directors onto and off the board of directors at the AGM. However, this often makes little difference, and shareholders have more power through buying and selling shares. If share prices drop significantly, the board may be encouraged to change their strategy. This separation causes problems due to the differing aims of the two stakeholders. The owners will want to maximize the returns on their investment, so will want a short-run profit maximize. However, directors and managers are unlikely to want the same thing. As employees, they will want to maximize their own benefits. This is the principal-agent problem, where one group, the agent, makes decisions on behalf of another group, the principal. In theory, the agent should maximize the benefits for those whom they are looking after, but in practice agents have the temptation to maximize their own benefits. It is for this reason that many firms are not run to profit maximize but to profit satisfice. The issue could be overcome by giving managers shares in the business or linking their bonuses to profits. This will mean that they personally will gain from higher profits. An extreme example of this problem is the Enron scandal in 2001. The executives used loopholes to hide billions of dollars in debt from the board of directors. The shareholders filed a lawsuit against the firm and the executives when share prices fell from nearly $100 to less than $1 in just over a year.
Next, the public and private sectors. In the UK, the economy is split into private and public sectors. The private sector refers to that part of the economy that is owned and run by individuals or groups of individuals, including sole traders and public limited companies. The public sector refers to that part of the economy which is owned or controlled by local or central government. The purpose of these organizations is to provide a service for UK citizens, and profit-making is not their main aim. Some may even make a loss which is funded for by the taxpayer. Now, profit and not-for-profit organizations. The private sector can be split into for-profit and not-for-profit organizations. Almost all private sector organizations are run to make a profit and to maximize the financial benefits for their shareholders. They may not necessarily profit maximize, but their long-term goal is to make money. Some private sector organizations are not for profit. Any profit they do make is used to support their aim of maximizing social welfare and helping individuals and groups. These organizations include charities and smaller organizations who aren't large enough to be classified as charities.
Next, we will be looking at business growth. Firstly, organic growth. There are two main types of growth: internal or organic growth and integration. Organic growth is where the firm grows by increasing their output, for example, increased investment or more labor. They may open new stores and increase their range of products. Almost all growth of firms is organic. An example of a firm who grew through organic growth is Lego. They introduced new products, such as Lego Friends and board games, to expand their customer base. First, the advantages. 1. There is better control and coordination. Firms maintain control whereas external methods lead to loss of control and ownership. 2. It is relatively inexpensive. The source comes from retained profits, less risk as the amount of capital involved is relatively lower than external. 3. The ability to maintain corporate culture. There are no problems related to culture clash that might arise in acquisition environments. Now, the disadvantages. 1. Sometimes another firm has a market or an asset which the company would be unable to gain through organic growth. For example, integration would allow a European company to expand into the Asian market which it has no expertise in. 2. Organic growth may be too slow for directors who wish to maximize their salaries. 3. It will be more difficult for firms to get new ideas.
Forward and backward vertical integration. Integration is growth through amalgamation, merger or takeover. A merger or amalgamation is where two or more firms join under common ownership, whilst a takeover is when one firm buys another. Vertical integration is the integration of firms in the same industry but at different stages in the production process. If the merger takes the firm back towards the supplier of a good, it is backwards integration. Forward integration is when the firm is moving towards the eventual consumer of a good. Tesco's £3.7 billion takeover of Booker in 2018 is an example of vertical integration. It has led to an increase in sales for Tesco. First, the advantages. 1. There is increased potential for profit as the firm takes the potential profit from a larger part of the chain of production. There will be less risks as suppliers do not have to worry about buyers not buying their goods and buyers do not have to worry about suppliers not supplying the goods. 2. With backward integration, businesses can control the quality of supplies and ensure delivery is reliable. Moreover, they don't have to worry about being charged high prices for supplies, keeping costs low and allowing lower prices for consumers. This can increase competitiveness and sales. 3. Forward integration secures retail outlets and can restrict access to these outlets for competitors. Now, the disadvantages. Firms may have no expertise in the industry they took over. For example, a car manufacturing company would have deep knowledge of car manufacturing but little knowledge of selling cars and vice versa.
Now, horizontal integration. This is where firms in the same industry at the same stage of production integrate. In 2015, AstraZeneca acquired ZS Pharma for $2.7 billion. It gave them access to new compounds and was a long-term deal intended to strengthen a specific sector of their business. Other well-known examples are Currys and PC Worlds and Arcadia, who own Topshop, Evans, and Dorothy Perkins. First, advantages. 1. This helps to reduce competition as a competitor is taken out and increases market share, giving firms more power to influence markets. 2. Firms will be able to specialize and rationalize, reducing the areas of the businesses which are duplicated. 3. The business is able to grow in a market where it already has expertise, which is more likely to make the merger successful. Now the disadvantages. 1. The problem is that it will increase risk for the business, as if that particular market fails, they have nothing to fall back on and will have invested a lot of money into that area. They are placing all their eggs in one basket. Next, conglomerate integration. This is where firms in different industries with no obvious connections integrate. They can sometimes be linked by common raw materials, technology, or outlets. Today, this is uncommon, but it was popular in the 1960s and 1970s. General Electric was founded as a lighting business and is now involved in aircraft, water, oil and gas, financial services, healthcare, energy, aviation, rail and software. It is a successful model because they conduct extensive market research and remain as market leaders in relevant industries. First, advantages. 1. It is useful for firms where there may be no room for growth in the present market. 2. The range of products reduces the risk for firms, and if a whole industry fails, they will still survive due to the other parts of the business. 3. It will make it easier for each individual part of the business to expand than if they were on their own, as finance can be easily obtained and managers can be transferred from company to company within the firm. Now, the disadvantages. The problem with this is that firms are going into markets in which they have no expertise. It can often be damaging for the business.
Now, let's look at constraints of business growth. 1. Size of the market. A market is limited to a certain size, and so not all businesses are able to mass produce because their goods would not be bought by consumers. This can happen no matter how big the market is, and there will always be limits on growth. In particular, niche markets, specific products that few people want, and markets for luxury items or restricted prestige markets make it difficult for businesses to grow. 2. Access to finance. Firms use two main ways to finance growth: retained profits and loans. If firms do not make enough profit or have to give out too much to shareholders, they will not be able to use retained profits to grow. Banks may be unwilling to lend firms money, particularly smaller businesses that they see as high risk. As a result, firms will be unable to grow as they can't finance it. 3. Owner objectives. Some owners may not want their business to grow any further as they are happy with their current profits, and do not want the extra risk or work that comes with growth. 4. Regulation. In some markets, the government may introduce regulation which prevents businesses from growing. For example, the UK government regulates the number of pharmacies in a local area, and an existing pharmacy can only expand by buying another company. Competition law, which prevents monopolies, can restrict growth, as any merger which creates a company with more than a 25% market share can be forbidden from taking place.
Lastly for today, demergers. A demerger is a business strategy in which a single business is broken into two or more components, either to operate on their own, to be sold, or to be dissolved. In 1997, Pepsi announced a demerger of its Pizza Hut, KFC and Taco Bell restaurants to focus on competition with Coca-Cola. This was welcomed by shareholders as the restaurants had failed to live up to expectations. Firstly, reasons for demergers. 1. Lack of synergies. This is when the different parts of the company have no real impact on each other and fail to make each other more efficient. Lack of synergy means managers are splitting their time between areas which are so different it could lead to diseconomies of scale. Firms may split in order to avoid these diseconomies. 2. Value of the company or share price. Some companies demerge because the value of the separate parts of the company is worth more than the company combined. This is because some parts of the business are operating well and have potential to grow, but the overall value is brought down because of the lack of success or lack of potential for growth of other parts of the business. Financial markets talk about creating value by splitting up companies like this. 3. Focused companies. Some people believe if the company and the management are more focused on individual markets, they become more efficient and successful, and make higher profits. Management have limited time and skills, and they are unable to spend the required time to make all areas of a huge diverse business successful. By focusing on one area, managers can improve their skills and knowledge and become more successful. 4. They may also want to avoid attention from the competition authorities. What are the impacts? 1. Workers. Workers could gain or lose through a demerger. Separate firms may need their own managers and leaders so people could get a promotion. However, the goal of making the firm more efficient may result in job losses. 2. Businesses. Concentrating on a smaller core business may enable it to be more efficient, and concentration may lead to more innovation and surviving higher competition. However, the smaller size of the business could lead to a loss of economies of scale and reduce efficiency. 3. Consumers. Again, consumers could gain or lose. They may gain from innovation and efficiency, leading to better products and cheaper prices. However, demerged firms may be less efficient through loss of economies of scale or raise prices or reduce quality or range of goods as they become motivated by profits. Thank you for watching our video. Please like, subscribe and share. And comment below so we can clarify things for you.